So imagine running a floating metropolis, right? And your primary variable expense, which is obviously fuel, just randomly spikes by nearly 30%.
Which is, an absolute nightmare scenario for that kind of operation.
Exactly. And at the exact same time, you've got consumer sentiment totally fractured globally. Plus, there's a major geopolitical conflict actively disrupting one of your most lucrative deployment regions.
Right. I mean, the textbook outcome for a setup like that is just massive margin compression.
Oh, yeah.
If not an outright bleeding of cash. You're asset heavy, you're capital intensive, you just get defensive.
Yeah, you go into survival mode. But now imagine stepping up to the earnings microphone and casually posting a 20% jump in net income anyway.
It's wild.
Yeah.
It completely defied standard operating logic.
Welcome to the paradox that we are tearing apart today. Welcome to this special Talk Tickers edition of The Deep Dive.
Glad to be here.
Today, we are taking a scalpel to Carnival Corporation's Q2 2026 earnings call. So that's ticker symbol CCL.
A really fascinating print to look at.
Truly. We are bypassing the standard Wall Street summaries today. We're digging directly into the actual machinery of this company for you.
Because that's where the real story is, right? The operational reality versus just the corporate narrative.
Exactly. Our mission here is simple. We're going to analyze the data points they provided, translate the jargon, and figure out exactly what this means for you, the retail investor holding, or maybe considering a position in CCO.
Yeah, let's get right into the headline numbers because they're pretty staggering.
Let's do it. So, Carnival reported net income for the second quarter of $569 million.
Right.
Which is more than a 20% increase over the prior year.
And that number actually carries even more weight when you measure it against their own internal projections.
Because they beat their own guidance, right?
Exactly. They didn't just edge past it. They beat their March guidance by $100 million. Yeah, so that translates to an outperformance of roughly 7 cents per share, which, I mean, for a company managing the sheer tonnage and logistical footprint of Carnival, finding an extra $100 million in a single quarter is, well, it's not easy.
No, it requires executing on multiple fronts at the exact same time.
Very much so.
But, I'm looking at the breakdown of this performance, and this is where I really need to press you on that fuel paradox I mentioned at the top.
Yeah, let's talk about the fuel.
Because the earnings transcript explicitly states their fuel costs went up nearly 30%. And in maritime shipping, or the cruise industry in general, fuel is the lifeblood.
Absolutely. It dictates your operating leverage entirely.
So if your main variable expense goes parabolic like that, how are you mathematically posting a 20% jump in net income? I mean, we've seen transport companies completely blow up their quarter on fuel spikes half that size.
Oh, for sure.
Yeah.
Airlines do it all the time. But you're touching on, I think, the single most critical operational pivot that management discussed on this call.
Okay, so what's the secret?
The answer lies in the mechanics of their fuel efficiency. They aren't just absorbing the higher cost per metric ton fuel. They are structurally altering how much fuel they actually burn.
Wait, really? Just burning less?
Yes. The data shows they improve their fuel efficiency by more than 5% year over year.
5%?
Right. So that's the absolute amount of fuel required to move a massive ship from point A to point B. And that 5% isn't just an isolated win, by the way. It builds on a 6% efficiency gain they already locked in during the prior year.
Huh. So the volume of fuel required is dropping fast enough to actually insulate the bottom line from the massive spike in the price of the commodity itself.
You nailed it. That's exactly the math.
But how are they doing that mechanically? I mean, you don't just ask a 130,000-ton steel vessel to suddenly be 5% lighter on gas.
Right. You can't just tell the captain to take his foot off the pedal. It requires a highly engineered approach. And while the call didn't, give us every single schematic, the mechanics of a multi-year efficiency gain like that involves serious tech.
Like what? What are they doing?
So it's algorithmic rate optimization for one.
Yeah.
And hydrodynamic improvements.
Okay, so mapping out better paths.
Yeah, they are definitely utilizing advanced software to map currents, wind resistance, and optimal cruising speeds down to the micronaut.
That is wild.
It is. And we also see the broader maritime industry leaning heavily into things like anti-fouling hull coatings.
Anti-fouling? What does that mean?
It's basically a special paint that reduces drag in the water, so barnacles and algae don't stick to the ship.
Oh, so the ship literally glides easier.
Exactly. Combine that with upgrading their HVAC systems and onboard power management. because, every megawatt of electricity you save on board directly translates to less marine fuel burned down in the engine room.
Right, because the fuel is generating the electricity.
Exactly. So they essentially broke the linear relationship between their fuel costs and their operational output.
That structural decoupling is massive. And honestly, it bleeds into another eye-popping number I saw on the balance sheet.
The deposits.
The deposits. They hit an all-time high in customer deposits, crossing the $9 billion mark.
Yeah, $9 billion.
When we analyze a company's capital structure, for you guys listening, having that level of cash handed over by consumers months or sometimes even years in advance, it changes the entire financial calculus of the enterprise.
Oh, completely.
Okay.
It creates this tremendous buffer.
Yeah.
And it's specifically because of the nature of that capital.
Right. Because it's basically a zero-interest loan from vacationers.
Exactly. Look at the macroeconomic climate right now. Heavily indebted companies are getting absolutely punished by the cost of capital. Interest rates are high. But Carnival is sitting on $9 billion of non-dilutive liquidity.
So they don't have to go to the debt markets.
Right. They aren't going to the bond market and paying steep yields.
Yeah.
And they aren't issuing new shares and diluting your equity to generate that cash either.
It's like Warren Buffett's insurance float. The consumers are financing the working capital of the business for free.
Exactly. At a 0% interest rate.
And they can deploy that massive float to actively manage obligations or fund short-term operations, all without tapping into really expensive revolving credit facilities.
It is the ultimate negative working capital model.
But, that deposit figure really only tells us that demand exists. People want to cruise. The real metric of pricing power that they hammered on during the call was yields.
Yes, yields.
The call said yields are up 2.2% year over year. Let's quickly translate that for the listeners. What is a yield in this context?
Yeah, good call. So in the cruise industry, yield is essentially how much money they are making per passenger per day.
Simple enough.
It combines the baseline ticket price you paid with the velocity of your onboard spend. So that's the specialty dining, the casino revenues, the shore excursions, the drink packages.
Okay, so a 2.2% increase means they are squeezing more juice out of every single passenger.
Right. And what's crazy is that this marks their 12th consecutive quarter of record yields.
12 quarters. 3 full years of record pricing power.
Yeah. Generating a 2.2% increase on top of 11 previous quarters of record highs indicates that their pricing engines are just highly calibrated.
They aren't just desperately filling ships with cheap tickets to claim high occupancy.
No, not at all. They are filling them with guests who clearly possess a high propensity to spend once they actually cross the gangway.
Okay, so top-line momentum is huge, hitting a $9 billion deposit record, driving yields up. But converting that revenue into a $100 million bottom-line earnings beat requires something else.
Margin protection.
Exactly. Aggressive margin protection. Which brings us to section 2 of our deep dive, the story behind the numbers. Let's talk about the operational deck plates and the specific levers management pulled to manufacture this outperformance.
Well, the primary driver wasn't just that they charged more for tickets. It was a really ruthless execution of cost discipline across the board.
Right.
The financial metric you really want to watch here is their cruise costs without fuel per ALBD.
ALBD, available lower berth day. Let's translate that Wall Street jargon really quick. ALBD basically just means one bed available for one night, right?
Exactly. It's their standard unit of capacity. And they managed to keep their costs per ALBD essentially flat year over year.
Which is, to maintain flat unit costs in this inflationary environment is incredibly difficult.
It's almost unheard of right now.
You're battling wage inflation, food cost inflation, higher port fees globally. To flatline your operating costs per bed per night means you are slashing expenses somewhere else to offset all those macroeconomic realities.
And management was very specific about this on the call. They noted that this strict cost discipline alone flowed directly to the bottom line, and it saved them a full 5 cents per share.
Just on pure efficiency.
Yeah. And the mechanism for that savings wasn't some massive corporate restructuring. They didn't sell off core assets. CFO David Bernstein characterized it as finding hundreds of little things.
Hundreds of little things. Which leads to arguably the most fascinating, hyper-specific anecdote of the entire earnings call.
The forklift.
The forklift. Bernstein highlighted their embarkation day logistics. So for you listening, think about the incredibly complex process of turning over a ship.
It's a logistical nightmare.
You're offloading thousands of passengers, loading thousands more, provisioning the vessel with literal tons of food and supplies, and you have to do it within a window of just a few hours.
Right. Time is money on the dock.
Exactly. And he specifically noted that brands across their portfolio had audited and optimized the number of forklifts utilized on the docks during this turnaround.
Yeah, he said they went from using 14 forklifts down to 13.
Okay, I have to push back here for the listener, because it sounds ridiculous to talk about one missing forklift on a multi-billion-dollar earnings call. How does a single forklift move the needle for a fleet of this massive size?
Well, I know, on the surface, bringing up a forklift sounds almost absurd. But you really have to look at the compounded operational leverage. It's a masterclass in the aggregation of marginal gains.
Okay, walk me through the math of the marginal gain.
So when you eliminate one forklift from a port operation, you aren't just saving the upfront capital expenditure of the machine itself.
Right.
You instantly strip out the ongoing fuel or the electricity required to actually operate it every day. You eliminate the preventative maintenance schedule.
The spare parts.
The spare parts inventory, yes. The insurance premiums tied to that specific asset. And crucially, the fully loaded labor cost of the operator driving it.
Oh, wow. I didn't even think about the labor.
Right. Now take that clustered savings, all of those things, and multiply it by over 100 ships across their global fleet.
Okay, yeah.
Executing turnarounds 52 weeks a year across dozens of international ports. That single micro-efficiency scales into millions of dollars in pure structural savings.
It's the maritime equivalent of that famous airline story, right? Where they removed one olive from every salad in first class to save $500,000 in jet fuel over a year.
Yes, exactly like the olive, but applied to heavy industrial logistics.
That makes total sense. They also explicitly cited utilizing AI efficiencies to negotiate vendor rates down, which points to a super sophisticated back-end supply chain strategy.
Right. They aren't just haggling with local port authorities on a clipboard anymore.
No, they're likely using predictive analytics to understand their precise provisioning needs. So they eliminate over-ordering, and they use bulk data to force better terms from their suppliers globally.
And that granular level of execution is exactly what insulated them from the massive macro shocks that hit during the quarter.
Because the cost-cutting wasn't just a fun exercise in boosting margins. It was basically a required defensive maneuver.
Yeah, against some really intense geopolitical headwinds. Throughout the whole analyst Q&A, the conflict in the Middle East was a very persistent theme.
Right. CEO Josh Weinstein was really transparent about the damage there. He stated the Mediterranean region took a direct hit.
It did. And the disruption wasn't just isolated to vessels trying to transit the Red Sea. The ripple effects significantly dented their broader European and Med deployments.
How bad was the hit?
Ultimately, the geopolitical situation knocked a full 100 basis points, so 1% off their total yield growth for the quarter.
But let's dig into the mechanics of that disruption, because it's vital for investors to understand why that happened. It wasn't merely a matter of consumer fear, right? Like people just being afraid to go to Europe?
No, it was a massive logistical dislocation in global aviation.
The airfare.
The airfare. We saw reduced international flight capacity and severely elevated airfares for North American guests attempting to fly into these European hub cities just to embark on the cruise.
So if a family in Ohio is trying to get to Rome to get on a Carnival ship, and the cost of the flight suddenly doubles,
it actively destroys their budget for the cruise ticket itself, which places immense downward pressure on cruise pricing.
Right, which presents a massive dilemma for revenue management. You've got ships positioned in Europe, demand is suddenly stifled by external shocks, and the cost to fly there has skyrocketed.
Exactly. And the typical industry playbook in that scenario is to panic.
You slash ticket prices.
You discount heavily just to get bodies into the cabins, hoping you capture some fractional onboard spend to make up for it.
But Carnival actively rejected that playbook here. And I think this is where their forward booking strategy really paid off.
It did. They entered the quarter already heavily booked. So because they had secured such a high baseline of occupancy months and months in advance, when the Middle East conflict flared up and the booking curve temporarily stalled, they didn't have to panic.
They had the inventory strength to hold the line on pricing.
Right. They prioritized price integrity over panic discounting.
They refused to train the consumer to wait for a fire sale.
Precisely. They basically said, we'll take the hit on volume for this specific window, but we are protecting the long-term pricing structure of our brands.
And when you combine that revenue strategy with the micro efficiencies we just discussed, the forklifts, the AI vendor negotiations, you see the complete picture.
Yeah, it all fits together perfectly.
The intense cost cutting completely offset the 1% yield hit generated by the Middle East conflict. They essentially lost a penny on the top line due to geopolitical instability, and they clawed that exact penny back on the bottom line through sheer operational grit.
They manufactured their own luck. They engineered their own insulation.
Which is an impressive level of operational control. But look, you can only cut costs so deeply. You can't shrink your way to long-term growth. Eventually, you have to engineer new avenues for high-margin revenue generation, right?
Absolutely.
Avenues that are structurally protected from competitors. And their earnings call revealed a massive pivot in their destination strategy. We really need to talk about their aggressive expansion into exclusive, vertically integrated port infrastructure.
Yes, because this is where a distinct real estate monopoly angle comes into focus for the stock.
The focal point of this strategy is Celebration Key in the Bahamas. Management detailed the completion of a massive pier extension there early in the quarter.
Right. And the scale of this facility is just mind-blowing. This single pier is now engineered to handle 4 of their largest ships simultaneously.
4 megaships.
Yes.
At once.
Yes. That equates to roughly 13,000 guests disembarking onto a single privately controlled landmass on any given day.
Let's just break down the logistics of that for a second. Moving the equivalent population of a small municipality off 4 vessels and onto a beach every single morning requires staggering infrastructure.
Oh, massive amounts of capital and planning.
But the economics of that movement are even more critical for the investor to understand. They aren't just building a dock to park a boat. They are building a closed-loop economy.
That is the perfect way to phrase it. Because think about when a ship docks at a traditional public port of call, like in Mexico or Italy or Greece.
Right.
The passengers disembark and immediately begin leaking capital into the local economy.
Right. They spend money at independent restaurants, they book tours with local operators, they buy souvenirs.
And they pay municipal transit fees. The cruise line captures none of that economic activity. It's lost revenue.
But when a guest steps off the pier at Celebration Key, that dynamic fundamentally shifts. The cruise line owns the entire ecosystem.
Exactly. Every single cabana rented, every premium beverage purchased, every shore excursion book, it all flows directly back onto Carnival's income statement.
They are effectively taking the highly lucrative captive spending culture of the ship and extending it onto the land.
It's brilliant. It is a high-margin revenue engine disguised as a tropical destination.
And the scale is accelerating fast. They are projecting Celebration Key alone will welcome 3.5 million visitors next year.
Just massive volume. And they are replicating this model across their portfolio, too.
The call highlighted a newly opened pier at Half Moon Cay.
Right, enabling 2 massive vessels to dock there simultaneously.
Which pushes the daily capacity at that specific location to over 12,000 guests.
So they are heavily differentiating the product by pairing this Caribbean infrastructure strategy with an integrated land and sea platform in other regions, too, like Alaska. Oh yeah, Alaska's huge for them. They already operate proprietary lodges there. Glass-domed rail cars, dedicated motor coaches.
They are securing preferential and in many cases totally exclusive access to destination infrastructure, which is becoming increasingly difficult for any new competitor to replicate.
Which serves as a perfect transition into Section 3 of our deep dive, how the market is going to value this company moving forward. Management guidance.
Right, because investors price in the future, not the past. They proved they can squeeze operational efficiencies to offset macro shocks today, and they're building high-margin moats for tomorrow.
But what did management actually guide for the next 18 months?
So they provided some very specific markers. Let's start with the immediate horizon. Carnival raised their full-year earnings per share guidance to $2.22.
Okay, so that's a 1-cent increase from their previous outlook.
It is. And interestingly, management explicitly noted that this bump is largely to account for the EPS accretion driven by their recent share buybacks.
We will definitely get to those buybacks in a second because that's huge. What about yields? They established normalized yield growth guidance at 2.25% for the full year.
So that signals they expect the pricing power we saw in Q2 to remain highly durable. It wasn't a fluke.
Not a fluke at all. But honestly, the most significant narrative shift in the guidance involves their capital allocation strategy.
The buybacks and the dividend.
Yes. They announced they were returning $1.3 billion to shareholders this year. That capital return is split between a reinstated dividend and an aggressive stock repurchase plan.
They've already executed $450 million of a newly authorized $2.5 billion share buyback program, right?
Exactly.
I mean, if you zoom out for a second and look at the trajectory of this company over the last 4 years, the contrast is just jarring.
It's night and day.
In the immediate aftermath of the pandemic pause, Carnival was forced to issue massive tranches of debt at punishing double-digit interest rates simply to maintain liquidity and keep the lights on.
They were just trying to survive.
Right. And now the enterprise is generating such a velocity of free cash flow that they are actively stepping into the open market, buying back their own equity, retiring those shares, and instantly making the remaining shares held by retail investors more valuable.
And they are executing those buybacks while simultaneously repairing the balance sheet. Management highlighted their continued deleveraging efforts.
Give me the numbers on the debt.
So their net debt to EBITDA ratio dropped from 3.4 times at the end of the previous year down to 3.1 times at the close of the second quarter.
Wow. Pushing that leverage ratio down toward that 3.0x threshold is a massive signal to the credit rating agencies.
Exactly what you want to see.
It proves the debt burden they took on during the crisis is rapidly becoming manageable relative to the operational cash they're generating. And as that ratio drops, the perceived risk of the company drops.
Which eventually lowers their cost of capital when they inevitably need to refinance existing debt maturities.
It's a compounding cycle of financial health.
It really is.
But, okay, I have to play the skeptic here. We have to address the geopolitical overhang because during the Q&A portion of the call, an analyst, Steve Wizensky, he pressed management on that 100 basis point cut to the yield guidance tied to the Middle East.
Right. He wanted to know how deep that wound was.
And management responded by framing the slowdown in consumer demand for the region as transitory.
The dreaded T word.
I have to throw a massive red flag on that specific word for the listeners. Transitory is arguably the most abused piece of corporate vocabulary on Wall Street today.
Oh, without a doubt.
We all vividly remember when central banks and CEOs insisted that global inflation was purely transitory right before it became deeply entrenched for years.
We certainly do.
So when management claims a demand slowdown is transitory, it often translates to, hey, we are facing a structural problem we cannot fix, but please do not sell our equity.
There's usually the subtext, yeah.
So why should any investor believe the geopolitical hit to European deployments is actually temporary?
Well, your skepticism is entirely warranted. The market aggressively punishes companies that mischaracterize structural decline as just a temporary blip. But, and this is big, but in this specific instance, the data management provided actually supports their assertion.
They brought receipts.
They brought the receipts. They aren't just offering a narrative, they pointed directly to the mechanics of their 2027 booking curve as proof.
Okay, walk us through the mechanics of that curve. How does 2027 data prove the 2026 problem is isolated?
CEO Josh Weinstein broke it down really clearly. He acknowledged there was a distinct pause in close-in bookings for 2026. Meaning consumers hesitated to book a Mediterranean cruise departing in the next 3 to 6 months, while active conflict dominated the news cycle.
Which makes sense. You don't want to fly into a volatile region tomorrow.
Exactly. But simultaneously, bookings for European deployments in the following year, 2027, are already tracking higher year over year in the mid-teens percentages.
Mid-teens growth for a year out.
Yes. And crucially, those 2027 bookings are being secured at higher prices.
Oh, wow. Okay, that implies the underlying consumer demand for the product never actually evaporated at all.
Exactly. It simply shifted to the right on the timeline.
It's similar to the bullwhip effect we see in supply chain management. The consumer still wants to sail the Mediterranean, they have the capital to do it, but they just altered their behavioral timing to wait out the immediate volatility.
Precisely.
Yep.
Because if demand had been structurally destroyed, you wouldn't see double-digit growth in advanced bookings at premium price points.
That's a great point.
Furthermore, Carnival is executing a highly disciplined strategy regarding their capacity. You know, the cruise industry is governed by massive lead times.
Right. You can't just react to a surge in demand by spinning up a new ship next quarter.
No, it requires billions of dollars and years of complex shipyard construction. And management emphasized that they are deliberately restricting their fleet growth to just 1 to 2 new ships per year.
So they are throttling supply.
Intentionally.
Yep.
They did announce orders for 3 new Princess-class ships, but get this, the delivery schedule is set for 2035, 2038, and 2039.
2039, setting capital expenditure schedules 15 years into the future highlights the extreme barrier to entry in this sector.
Huge barriers. But the strategic takeaway there is the intentional constraint. By severely limiting the number of new, lower berths entering the global market over the next decade, management is effectively utilizing forced scarcity.
Classic supply and demand economics heavily manipulated in their favor.
Right. By keeping supply tight, they ensure that the growing consumer demand continues to outstrip available inventory. And when demand structurally exceeds supply, your pricing power becomes incredibly inelastic.
Because you never have to resort to widespread discounting to fill your vessels, because there simply aren't enough ships to accommodate everyone who wants to sail.
Exactly. And instead of pouring massive capital into new builds right now, they are redirecting that cash flow into what they term return-generating modernization programs.
So upgrading the existing boats.
Yeah. They are taking their existing fleet, bringing the ships into dry dock, and executing targeted upgrades. Adding high-margin premium cabins, upgrading the casino floor, revamping the dining venues.
And I imagine that requires a fraction of the capital expenditure compared to building a brand new vessel, but it yields a highly accelerated return on investment.
It is an incredibly capital-efficient way to drive yield growth without diluting the broader market with excess capacity.
Which brings us perfectly to the culmination of this analysis, the bottom line. We've audited the headline numbers, we've dissected the operational mechanics behind the cost discipline and the destination moats, and we've pressure tested management's guidance for the future.
We've covered a lot of ground.
We have. So what is the actionable conclusion here? What is the definitive signal for the retail investor analyzing the CCL ticker right now?
Look, based on the underlying mechanics revealed in this specific earnings print, the signal is aggressively bullish.
Aggressively bullish?
Yes. The narrative surrounding Carnival needs to fundamentally shift. For the past several years, the market has treated this stock as a highly volatile post-pandemic debt recovery play.
People were just wondering if they'd go bankrupt.
Exactly. Investors were constantly monitoring liquidity just to ensure the company could service its massive interest burden.
But this quarter proves that the metamorphosis is largely complete.
It really does. We are no longer looking at a distressed asset trying to tread water. We are analyzing a highly optimized, disciplined cash flow machine.
And for any retail investor out there, the ultimate litmus test for the underlying health of a corporation is its financial flexibility.
And Carnival is currently demonstrating massive structural flexibility. Just consider what they are executing simultaneously.
Okay.
They're deploying hundreds of millions of dollars in capital expenditures to build out massive private island infrastructure like Celebration Key.
Right.
At the exact same time, they're aggressively paying down their pandemic-era debt stack, successfully compressing their leverage ratio to 3.1x.
Yeah.
And concurrently, they are generating enough excess cash to reinstate a dividend and buy back $500 million in stock off the open market.
You just cannot fake that level of liquidity.
No, you can't.
A management team can spin a masterful narrative on a conference call, but you cannot fake the actual cash required to simultaneously fund massive capital projects, aggressively retire debt, and execute share repurchases. The balance sheet doesn't lie.
It does not. And their ability to completely offset a major geopolitical shock in the Mediterranean simply by optimizing logistics.
By reducing the forklift count.
Exactly, reducing the forklift count on their docks. It proves that the operational deck plates are locked in.
They have effectively de-risked the near-term volatility by stretching their booking curve further out, and they've fortified their pricing power by artificially constraining their own capacity growth.
It truly is a masterclass in capital allocation and operational leverage. They've transformed macroeconomic headwinds into a baseline for efficiency.
Which leaves us with one final provocative angle for you listening to consider. Something that stretches beyond the EPS spreadsheets and the debt covenants.
This is the real long-term play.
I want you to think critically about Carnival's aggressive land grab with these private destinations. Celebration Key, Half Moon Cay, Isla Tropical and Rotan.
Because these are not just nice amenities for the guests. They are massive, exclusive infrastructure assets.
Look at the global macro environment regarding maritime infrastructure right now. Strict environmental regulations are making it increasingly difficult, prohibitively expensive, and just politically toxic to dredge and build new megaports.
Oh, absolutely. Good luck getting permits for a new megaport anywhere.
And at the same time, local municipalities in historic European and Mediterranean destinations, places like Venice or Amsterdam, they are actively pushing back against over-tourism.
Right. They are capping the number of cruise passengers allowed to disembark daily.
So securing private, dedicated, high-capacity port infrastructure isn't just a revenue play for Carnival anymore. It is a vital necessity for survival.
It really is.
Are these exclusive long-term island leases becoming insurmountable real estate monopolies? Think about it. If a heavily capitalized competitor wanted to start a rival cruise line tomorrow, they could probably secure the billions required to build the ships.
Sure, Wall Street would fund the ships.
But they absolutely cannot manifest a private Bahamian island with a deep water dock capable of handling 13,000 passengers a day.
No. The regulatory and geographic window to acquire those kinds of assets is rapidly closing, if it hasn't closed already.
It forces a fundamental revaluation of the enterprise. The intrinsic value of the company is no longer solely derived from the floating steel.
The moat is the sand.
The moat is the sand. You are investing in exclusive tropical infrastructure that just happens to be serviced by ships.
It's a completely different paradigm.
Something to carefully weigh the next time you look at the trajectory of the CCL ticker.
Absolutely.
A massive thank you for joining us on this Talk Tickers deep dive. We know your time is valuable, and we hope tearing apart the actual mechanics of this earnings call provided you with the clarity needed to cut through the Wall Street noise. Keep digging into the data, keep challenging the narratives, and we will see you on the next deep dive.